So, here's a wild question for you. Could the crazy, fast-paced world of cryptocurrency actually offer a solution to one of the biggest, oldest problems in finance, national debt? I know, it sounds a little like science fiction, right? But some really fascinating new ideas suggest it might not be so far-fetched. Let's dive in and see how. All right, first things first, we need to wrap our heads around just how big this problem is. As of late 2025, the UK's public sector net debt is sitting at a jaw-dropping £2.8 trillion. That's not just some abstract number, it's a massive weight on the entire economy. And that, of course, brings us to the big question. How on earth does a country even start to deal with a debt that massive? You know, the usual solutions have their limits, not to mention huge political costs. And that's forcing people to start looking for answers in some very, very unexpected places. To really put that £2.8 trillion figure into perspective, it's about 96% of the UK's entire economic output for a year, the GDP. The traditional answers, things like big tax hikes or major spending cuts, what we call austerity, well, they're incredibly unpopular and politically painful to implement. So you can see why there's a real hunger for some fresh thinking. And this is where it starts to get really interesting. There's this whole new financial toolkit emerging from the world of crypto and blockchain. So in this explainer, we're going to explore 5 strategies, and yes, they are speculative, that seriously propose using this new tech to take on national debt. Okay, so we've got 5 big ideas on the table. For each one, we're going to break down how it's supposed to work, what the potential upside could be, and maybe most importantly, what the catches and the big risks are. First up, we have something called tokenized gilts. The core idea is actually pretty simple, but it's powerful. You take a normal government bond, in the UK they're called gilts, and you turn it into a digital token on a blockchain. Suddenly, anyone, anywhere in the world, could buy a tiny piece of UK debt 24/7 for just a few pounds. And the potential payoff here? It could be huge. By opening the doors to the $2 trillion global crypto market, you could massively increase the number of potential investors. And you know what more demand means, right? It could lower the interest the government has to pay, possibly saving somewhere between 14 and 28 billion pounds a year. Not to mention, automating all the paperwork with smart contracts could slash admin costs. So here's the classic trade-off. The really clever twist is a marketing one. You could create a patriotic Britcoin gilt, and even reward people who hold it long-term with airdrops of the new digital pound. But the risk? Well, you're tethering a traditionally stable government asset to the wild swings of the crypto markets. That could totally backfire and actually make borrowing more expensive. Okay, if you thought that was bold, buckle up for strategy number 2. This one is way more aggressive. The proposal is to create a UK digital reserve fund. What that means is the government would take a chunk of its national reserves, we're talking 50 to 100 billion pounds, and actively invest it in major cryptocurrencies like Bitcoin and Ethereum. And just look at this proposed portfolio. This is not playing it safe. We're talking a massive 60% in Bitcoin, which some see as digital gold, 30% in Ethereum for all its uses in DeFi, and then just a small 10% safety cushion in stablecoins. The whole idea would be to sell off the profits during bull runs to help pay down the national debt. Now, there is a clever angle here. You could tie the whole strategy to green initiatives, like using Ethereum's network to manage carbon credits, which could attract big environmental-focused investment funds. But, and this is a huge but, we're talking about crypto's legendary volatility. A 50% drop in value isn't just possible, it's happened before. And for taxpayers, that could mean amplifying losses instead of generating gains. All right, let's switch gears for strategy number 3. This one takes a totally different tack. It's all about crowdsourcing. It's basically a voluntary program where super wealthy crypto holders, you know, the whales, could donate some of their crypto directly to the government. And in exchange, they'd get perks like tax credits or forgiveness on other debts. And this is where it gets, well, very 21st century. The proposal suggests gamifying the whole thing. Imagine donors getting exclusive NFT badges, like a Debt Slayer award, that could unlock real-world benefits like VIP tickets to Wimbledon or other huge events. It's basically turning philanthropy into a status symbol. So the genius part is tapping into that viral meme culture energy. But the massive risk here is something called moral hazard. The public could easily look at this and not see it as a generous donation drive, but as a sneaky tax loophole or a bailout for the super rich. And that would create a huge political firestorm. Now, strategy number 4 takes us a little bit into the future of the UK's own money system. The Bank of England is already working on its own digital currency, or CBDC. This idea says, hey, once we have that digital pound, why not use it to borrow money directly from the world of decentralized finance, or DeFi? The really cool innovation here would be creating dynamic yield bonds. Their interest rates could literally adjust automatically in real time based on what's happening in the crypto markets. Fascinating, right? The terrifying part, though, is security. DeFi platforms are a massive target for hackers. One little bug in the code could lead to a catastrophic, irreversible loss of public money. And finally, we've arrived at what is, without a doubt, the most controversial idea of the bunch: fractionalized heritage tokens. This would involve taking some non-essential public assets, think certain crown estate properties, maybe even historical items, and selling off tiny, tokenized shares of them as NFTs to investors all over the world. Now, the cool twist is this idea of a heritage DAO, which is like an online collective where all the token holders could vote on how the asset is used, creating a sense of community ownership. But you can already see the problem, can't you? The risk is a massive cultural and public backlash against the government for what everyone would call selling off the family silver. Okay, so we've walked through all 5 of these pretty wild ideas. Let's pull back for a second and look at the big picture. What does this all add up to when you weigh the potential against the very real pitfalls? This chart really puts it all into perspective. The sources suggest that if you combined all these strategies, you could potentially reduce the debt by 140 to 280 billion pounds over a decade. Now, don't get me wrong, that is a huge amount of money, but as you can clearly see, it's still just a small dent in that massive 2.8 trillion pound debt mountain. And on the other side of the scale, you have to stack up all the risks that seem to run through every one of these ideas. We're talking about extreme market volatility, the constant threat of hacks, the chance of a fierce cultural backlash, that problem of moral hazard, and, the simple fact that the rules and regulations for all this stuff are still being figured out. Which brings us to this quote from the source material, and I think it just sums everything up perfectly. Crypto isn't a silver bullet. None of these ideas are going to magically make the national debt disappear. But what they might do is turbocharge a new way of thinking about finance for an economy that's becoming digital first. And that leaves us with the final big question to think about. Is embracing this kind of radical financial innovation the jolt that a modern economy needs to stay ahead of the curve? Or is it all just a gamble that's a step too far, risking public money and public trust on a volatile and still unproven technology? It's a huge debate, and it's really just getting started.